To discuss Kenya's banking sector, we have in studio Habil Olaka. He's a Chief Executive Officer at the Kenya Bankers Association. A very good afternoon to you, Habil. Now, the very big question here now is why are banks not responding to the central bank's cut of 350 basis points that we have seen, that we saw last week? We've only seen two banks cutting rates, with some people saying when the central bank does increase rates, we do see banks increasing faster than they decrease. Yeah,
thank you very much. As you have mentioned, actually, the central bank has reduced the central bank rate by 350 basis points. Now, the expectation in the market was that the banks would more or less react immediately and respond to it, just like they did the last time when it was cut from 18% to 16.5%. And indeed, you have seen, as you have mentioned, two banks have already responded and reduced their lending rates by almost a similar margin of 350 basis points. Now, the reason why banks may not be, or rather they are being perceived not to be responding as quickly as expected is because what happens is that when the central bank rate comes down, which is a policy rate, it signals the market to come down. Now, it's only when banks are able to pick cheaper deposits that then they are able to transmit that through their lending by offering lower loans based on their reduced cost of funds. Now, a number of them are still struggling with the more expensive deposits they picked earlier, and it's only upon the rates coming down that they'll be able to transfer that to the borrowers. Now, somebody may ask, why is it that some banks have responded almost immediately while others are delaying? And it's purely a competitive strategy, because the banks that have decided to bring their rates down are those that, even though they have not felt it yet in their deposit side, they have decided to bring it down so that they can most likely catch up on the market share.
Let's look at the outlook for the banking sector going forward. We know that the banking sector has really benefited from the high interest rate environment, but now we're sitting in an environment where interest rates are going down. In your view, what is the outlook for banks given the scenario?
I think in terms of the rates coming down, I see the rates coming down sequentially, and in view of the fact that most probably the next MPC announcement may be as a reduction, maybe not by a similar kind of margin, but by a similar trend. I see going forward the cost of funds for the banks slowly coming down, and then the banks slowly responding through transferring the same to the borrowers. But the other thing that must have been picked up at the MPC announcement was the issue about the spreads. Because there's a lot of pressure on the banks to reduce their spreads, currently operating in the region of between 10 and 12%. And of course, in a high interest regime, what tends to happen is that because banks tend to be more cautious, the spreads tends to be high. But as the rates come down, as the cost of funds come down, I'm sure the spreads will shrink with time.
Let's talk a bit on the health of the banking sector over in Kenya. There seems to be a bit of a disconnect when you compare the bigger banks to the smaller banks. We've had the bigger banks reporting some rather stellar results, but when you look at the smaller banks, they seem to be struggling at this stage.
Yes, okay, not quite struggling, but I think what happened was that at the time when the rates were high, the bigger banks were able to rely on their big customer base, and so they were picking deposits from their current accounts and the saving accounts, which can be quite significant. So if you look at the total deposit portfolio of the banks, the large banks, few of them were relying on, say, the interbank or the corporate large deposits, which tend to be more expensive. Now, the smaller banks, because they don't have the branch network, they tend to rely more on the interbank, for example. And at one point in Kenya, the interbank was actually operating in the range of 30%. So if a bank relies heavily on such expensive deposits, it will definitely show in their profitability at the end of the period. So that period, smaller banks tended to suffer more from the high interest regime than the larger banks.
We've seen a number of banks coming through the market in terms of rights issues, looking to expand across the regions. Just talk us through some of the competitive landscape within the region and where you see opportunity for Kenyan banks at this stage.
Okay, one of the things that has developed in the country is that I've seen a number of Kenyan banks trying to take advantage of the market, the ESC market generally. And in fact, as we speak today, a bank like KCB can boast of being in all the 5 East African member countries, including South Sudan. Banks like Equity Bank, NIC, CBA, quite a number of the Kenyan banks are now having a footprint in the region. And in order to finance that expansion, a number of them have had to go either to the capital markets or have rights issues or even private placements. So there's a lot of action going on in terms of positioning themselves to take advantage of the market that is now becoming apparent.
Well, that's where we have to leave it. That was Habil Olaka, Chief Executive Officer at the Kenya Bankers Association, joining us from our studios in Nairobi.